We will start at 8 o'clock. Okay. Hi, everybody. Can you all hear me and see me? You can hear, don't mind type one. That's why I know you all can hear and see me. Okay, thank you. Okay, good evening. So, hope you all have taken your dinner already. So today we're going to talk about US office REITs. Okay, so sorry, before I start, it's a standard disclaimer. Okay, what I share is for knowledge and information only. It doesn't constitute any financial advice. Okay, and a fast introduction about me and my team. Actually, we are from Jurong East Investor Center. In case some of you see us for the first time, but I believe majority of them are Jurong East client. Okay, I'm also a trainer for IBF accredited program. Where I conducted 2 courses. One is called the Lifetime Income Mastery, and the other called the Risk Analysis, where you can enjoy up to 70% subsidies on the course fee by IBF. Okay, I also got this YouTube channel. You can follow me on my YouTube, okay, where I talk about Singapore market, and also now we'll have more on US stocks also. Okay, and you can also follow my Facebook page in case I got a new webinar. You can just follow me on that so they can register for that. So this is the summary of me, Darren Chu here, Senior Financial Services Director at Philips Securities. Have been in this industry for more than 18 years. Okay, but before I joined this industry, I was an engineer, worked as an engineer for 10 years. Okay, so for those that want to make a career switch to the industry, you can talk to me separately. I'm also a qualified member for the top of the table. That's the highest qualification an advisor can achieve in this industry. Okay. So that is what we're going to talk about for today. But bear with me, before we talk about this, I'm going to share with you some things, information first on that. Okay. Okay. So I just want to talk about this Cash Plus account. Okay. Because up to today, if let's say you happen to have sell in CPF SIs, you can use a Cash Plus account to sell it off. Okay, because you enjoy a lower brokerage commission. Please don't sell it off from your cash management account. Your CPF SI share that bought in other place or any place or even in Poems another account, you can sell it off to your Cash Plus account. Okay, so that's one thing to think. And if you're share in CDP, you got consider, I have a question on that. You cannot sell to Cash Plus account. You can only sell to a cash management account unless you transfer the share from CDP to Cash Plus account, then you sell it off. And you really plan to sell it off, I think transfer over to sell it off if timing of selling is not very crucial for you. Okay, you can transfer over, then you sell it off because it directly actually you save more brokerage commission. Your transfer costs you $10 plus 8% GST. Okay, but selling here minimum $25. So this is something you can wait on that. And also Poems is a multi-asset platform. And one thing I don't talk about this multi-currency account, which is a money market fund. Okay, with the current high interest rate environment, you can actually park your money here to earn high interest rate. Okay, this is based on from Poems website directly. You can go Poems website to see directly. Yeah, just this short. This is based on 7-day analyzed. So currently, a Sing dollar is based on 3.753% returns. Okay, this is based on 8 of May, and US dollar is 6%. But do take note, this rate will fluctuate on actually a daily basis. Okay, but you will not be from 3.7 drop to 1% that time. Okay, because based on interest rate, if there is no sudden drop in interest rate, this rate will not have a sudden drop also. So this is just for your knowledge and information. For those like 60 Poems account client, you can just transfer money in. Okay, and minimum money to go in is $100. Okay, and there's no lock-in. To take out the money is T plus 0. That means submit before 10 a.m. today for the withdrawal. By end of the day, you'll see the money in the bank account. Okay. So this is, and for those that want to open a Poems account with us, you can just scan this QR code on that. For those existing Jurong East client, you don't have our contact, please remember to save our contact. And also there is a notice for Jurong East client. Okay. For you know that we have a Telegram broadcast. Okay, we have a Telegram broadcast, but we are migrating it to WhatsApp community. Okay, WhatsApp community. So actually we have posted the link to join this WhatsApp community in the Telegram broadcast. Okay, so you can just click on it and join into our WhatsApp community. But let's say you don't have that link, you happen to not able to join in all this, you just drop our Jurong East team a WhatsApp message. We are able to just add you in. Okay. For those that can't find the Jurong East number, this is a number. Okay, this is a number. Or if cannot find or you contact me also, I can also add you in on that. Okay, so that is on some administrative matter. So now let's go and look at Manulife. Look at US REITs, US office REITs. So this is the return, okay, of the US office REIT listed in Singapore. Currently we have 3. One is called Manulife. One is called Prime US, and the other one is called Keppel Pacific Oak. Okay, so these are the 3 And let's look at their price return over the 1 year period. I based on last Friday closing price. Okay, last Friday and today, I think the price difference will not be that drastic. And I compare it with the IH index, S3 index. This one, there's an ETF called CSOP, Singapore REITs Index. I think they follow this index. And I also put in the STI ETF, STI index, not ETF. STI ETF will follow this STI index. Okay, so from here, you can see for the past 1 year return, STI actually is flat. Okay, this today on this price return exclude dividend. The REITs index is negative, but negative slightly 8%, not that bad. With current interest rate rising environment, okay, drop about 8%, I think still quite reasonable. Okay, but you look at these three REITs. The worst one is Manulife have down 76%. Okay, the prime years rate are down close to 70%, 69, and PenPac have Pepper Pack have down about close to 53%. Okay, so actually easily they lost more than half in values. And do think of this is REITs. Okay, this is really a lot of people thought that REITs is safe. This will tell you that REITs does it really safe in this aspect. Okay, so but then a lot of people will say that we have dividends. So let me just add in the dividends. Total return. Total return means what? Include dividends. Okay, but STI, I didn't add in the dividend, you can just add in yourself maybe plus 3% more, because STI dividend yield about 3%. Okay, this is the REITs index with dividend yield. So you can see it still suffer slight losses. Okay, maybe 4%. But I look at these three of them. After adding the dividend, Manulife still lost 70+%. Okay, prime years rate 66%. So Pepper Pack slightly better than 50, lost 50%, now become 48, but it's still a huge loss for these three of them. Okay, and let's draw the timeline further. A lot of people say when I invest for long term. IPO. Okay, since IPO, if you were to buy these three REITs during the IPO period, Manulife REITs is the one that IPO the first. Okay, that is by something around 2016. Okay, and followed by this is the one. This is the Pepper Pack that IPO around 2017, and then followed by the Prime, which is the one that IPO around 2019. Okay, before the COVID. So you have to buy them and hold it today, since IPO and hold it today. This is your losses. Okay, it lost even more. Okay, Manulife lost 81%. This one lost 76, this one 72. Okay, but you look at the REITs index. Okay, this one based on track Manulife, because Manulife is the longest one. So the REITs index give a positive 4.77%. Okay, surprisingly, it lose to STI. Okay, it lose to STI maybe because of this current period on that. Okay, and let's look at the dividend. You will add in the dividends. And that means you buy Manulife REITs since IPO and collect the dividends, and hold it under today, you still lose 66%. Okay, Prime year still lose 67%, and Pepper still lose 47%. So that means that you buy 1 year ago and buy since the IPO to today, actually your losses is about the same. It is huge losses. Okay, but this one REITs index, they get 50%. So actually what happened to these three REITs, I think most people will be aware what actually have happened. Okay, it's work from home. But let's look at these three, although all drop, but there's still a slight difference in their losses. Okay, so let's go into to look at individual to have a view of how these three REITs is. Okay, first let's look at US first. Manulife first. Is the first pure play US office listed in Asia. So it's number one. Okay, first to come to Asia. Okay, so it comprises of 11 properties. Okay, and it have asset about 1.9 billion. Okay, the market cap is 373 million US dollars. But do take note, this market cap is based on 31st of March. Okay, based on 31st of March. So today the price, like last Friday was the price, Okay, we'll look at the market cap again. Okay, so this is what they are now. Okay, and Manulife of US office REIT, they are good properties in a way that their property is either Class A or trophy office portfolio. Okay, and they are located at Gateway City. Okay, Gateway City means a key city. Okay, key city. Like LA. Okay, what's a Gateway City? Gateway City are the main city. Definitely, you go overseas holiday, US holiday, you definitely will touch down in one of these cities. Okay, you don't go to their second tier city, third tier city, or suburban city. So this is called Gateway City in a way there. Okay, like New York, definitely is a gateway city. Manhattan, okay, it's definitely a great gateway city. So this is what I mean by. So they are on all the so-called the financial district, okay, the prime location, and this is where their property are located in. Okay, and what actually happened last year is when they announced, all REITs need to value their properties at least once a year. It's very different from stocks. Okay, different from company. They have properties, but they are not in a property business. They may be in semiconductor business, they may be in manufacturing business, but they own the buildings. Okay, but it's not a requirement to them to do valuation on a yearly basis. Okay, because that's nothing to do with their property, their business. But for REITs, they need to value their property at least once a year. Okay, and what happened to Manulife when they do a valuation at 31st of December? That is a 10% drop in their property values. Okay, 10% drop. And you can see the LA property dropped 33%. Okay, so property value drop. For those that look at it, if you buy your own properties, if let's say you buy your own resident property, you take the loan from the banks. Let's say you take 75% loan from the bank. Bank will calculate how much can you borrow, okay, based on the property values. But what happens when your property value drastically drop? Okay, there may sometimes call margin call. Bank will ask you to top up because it's over the limit they can borrow you. Okay, so that is on why valuation of property is important for REITs. But for REITs, it's not in that way. It's for REITs because there's something called gearing. Okay, there's something called gearing where the gearing is based on debt divided by asset. Okay, the requirement by MAS is 50%. Okay, so for debt to remain constant, like debt constant, because if they don't do refinancing, okay, you see debt will not be really that will remain constant, okay, in certain aspect. Okay, but if your asset value were to drop, your gearing will only go up. Your gearing will, because gearing equals debt divided by asset. Okay, so this is what happened to Manulife. Okay, US after they announced a 10% in valuation, the gearing dropped to increase to 48. If I know 48.6% around there. Okay, that's based on 31st of December. Okay, so it is almost hit the 50%. But let's look at the latest business result. That's 3 months later, 31st of March. Their gain further increased to 49.5%. Okay. Why is that so? As I mentioned, debts, right? Because they still got other things. Okay, they still got revolving credit, all these things, and their interest cover also dropped to 2.9 times. Okay, from 3+ times. MAS requirement is 50%. Here is 2.5 times. Okay, but MAS got a rule. Okay, if the gearing were to pass 50% due to things beyond the control of the REITs. What do you mean by beyond control? Property values. Okay, property values drop. So that's something they said beyond control, in a way beyond control rate. Then if we pass 50%, they never break the law. Okay, got that. But if the risk manager go and borrow under cross 50%, then it's the risk manager fault. Break the law lah. Okay, not fault. Okay, so for this case, even if it were to cross 50%, it didn't break the law. But at 49.5%, the risk manager can't take any more borrowings. Okay, that means if they want to do day-to-day operation, they must have cash in their bank account to do cash operation. They cannot utilize the bank credit facility because they will be borrowing already. Okay, and they cannot do AEI because AEI need money to borrow money. So that means the REITs now can't do anything. Okay, they're being holded and they can't do anything now. Okay, so this is what is happened when this happened. Okay, and this is definitely very negative impact to the REITs. Okay, and also we know that the interest rate will continue to rise, and this one will continue, high possibility will drop. It will drop further if the interest rate is going to go up. Because they are not all their debt are in 100% fixed rate. Okay, only 80% is fixed rate. So that means there's another 20% variable. And this 20% variable, and we now at this current juncture, unless the Fed has stopped interest rate high, the interest will higher, and this will further affect their interest cover ratios. And the rule is 2.5 times. Okay, so this is what is happening now. Okay, and so what can you do when the risk get so high gearing? There's many two ways to do it. One is to sell properties. Okay, why is to sell property? Sell property so that because you don't sell property, you get back some money to clear the debts. But that is definitely not a good thing to do. Okay, but no choice to do. And now one is to ask for capital injection. Okay, ask for capital, ask people to fund money, take money from investor and clear the debt. So there's only two ways they can do it. Okay, so what they do, they sell off one properties. Initially they got 12, so now they left 11 because they sold off one property and sold to who? Sell back to the sponsor. Okay, sell back to the sponsor. Of the sell back to the sponsor, of course, based on the current valuation price. Okay, not based on 1 year ago valuation, based on current valuation price. Okay, that is what the sponsor does, buy at valuations. Okay, but whether it's higher and lower than what they purchase price, that one you can go and check by the old history. But that one is old thing, and the sponsor buy from them, didn't mark up, didn't cut down their price, it just buy from the valuation price. Okay, and then one thing about Manulife US REITs is a bit unique. Okay, a bit unique compared to the two is there is a sponsor limitation. So when it comes to this type of crisis, usually the sponsor will be able to come in to rescue. What the sponsor will come and rescue? Inject capital. But inject capital will definitely create dilution because need to issue more units. But for this Manulife sponsor, they say they cannot inject capital at all. Okay, to this REIT. They say, I got money, but I cannot help you. Okay, why? Okay, because they say that they are bound by the rule that they cannot hold more than 9.8% of the holdings. Okay, when it comes to REIT sponsor, we all look at 20% or more to have an interest in the REIT. But for Manulife, since day one, they tell you that we will not hold more than 10%. Okay, because they say build to the tax structure, they say it that way, that they will not hold more than 9.8%, 10%, so that investor can enjoy tax-free rates. Okay, so what they do, they look for a strategic review, and then finally what they do is to sell the risk management side. Okay, what do we mean by that? And they found this company called, okay, I don't know how to pronounce it. Mira, okay, I think it's a Korean company. Okay, to not buy over the REITs. Okay, not buy over the REIT. If you are a unit holder, you still a unit holder. Buy over the REITs manager. For those that not sure how the REITs work, okay, there's this sponsor. Then you got all this group of properties. Okay, so you have to manage by a REITs manager. And this manager is a company. And you see it's not listed. And this REITs manager company is actually 100% owned by the sponsor. So they're going to sell this away, okay, or in a way that let this one take over, okay, and so this one become the REITs manager. Okay, so Manulife, would they still be continue to sponsor? That's something that we shall see. Okay, because it's something that become a third party REITs manager in a way. Okay, and so they want to gain control of the REITs, so they manage the REITs because they'll be the one that collect the fees. So this is what will going to happen, okay, on that. So they'll subscribe 9.8%, okay, of the new units, okay, of the new unit. And also the sponsor will also want to maintain their 9.1% stake, okay, 1.1% stake. But by doing new units, by doing new units through a placement at current price, okay, will definitely have a huge dilution to investor. Okay, so unless they practice what some of the REITs do, just like some of the REITs do, like Maple Tree Commercial Trust by over Maple Tree North Asia Commercial Trust. The issue price is higher than the Maple Tree North Asia Commercial Trust share price. Okay, that one, then that's how the merger. Then of course the small sponsor makan everything. Okay, but that's a separate issue. This is selling off the REITs management prospect. Okay, so this will definitely cause dilution. Even if they were to mark up the price against the current market price, but how fast can you mark? How high? How more can you mark up? And if you are someone that want to buy, you of course would not also want to buy at a very high price also. Okay, so this is something what is going on now, but what is going to happen? What price you're going to buy is an unknown. What will be the structure like? Is currently is unknown yet. It's not disclosed, but they should be disclosing quite soon. Okay, because I think cannot keep on drag already getting a hit 49.5%. Okay, so that is something we need to expect. Okay, so just to share, this is how you find. Some people ask how you know that the sponsor have how much holding. You just need to go to the annual report, and it will tell you that 9.13%. The sponsor interest is 9.13% on the REITs. Okay, this is in the annual report you publish every year, so it's very transparent in a way. Okay, but of course along the way you may some changes. You want some changes, then you can go to SGX website. I think you can find some information there. Okay, so this is the data of Manulife as of last Friday. The net asset value is 5.57 cents US dollar. Okay, but the share price is 14.2 cents. So this is, you can see the price to NAV is 0.2 cents. So it is not undervalued. I do take note. This is called trading at a discount. It is definitely not undervalued. It is just purely trading at a discount. Okay. So is it really cheap? That will depend on how you look at it. Okay. And you look at their market cap, that's why I show you 300 million. Now market cap will reduce to 252 million. Okay. It become the one of the smallest, not the smallest three. I think smallest three even smaller, but it become in the market cap, they are ranked at the bottom of those 30 over REITs. They are now ranked in the bottom already for market cap because the price dropped a lot. And dividend is 33.45%. Please don't see it's 33% yield and you jump in. Okay. Okay. You will not get 33% one, even you buy at this price. Okay, you will not get 33% yield. That's something you need to take note. Please don't think you buy, you get 33%. This yield is based on what? The DPU over current price. Okay. So if there is a dilution coming, the DPU would have to drop. Okay. The DPU have to drop. And if the dilution coming, the current price also will drop. So please don't think, oh, I buy 33.41%, I can make back the money. No. Okay. So that is something to think of. So please don't focus too much on the yield when you invest in the REITs. Okay. The yield can mislead you into buying in the wrong, something wrong. Okay. Next, let's look at the other one. After that, we'll combine all three and take a look. Okay, there's a prime US REITs. This prime US REIT got 14 office properties. Okay, along the way, you got any question, can just start in the chat. Then I can just answer accordingly. Okay. Their value is about 1.54. So they got 14 property, but their property value is lesser than Manulife, which is now is about 1.9. The occupancy is 89.1. Manulife is lower, 80+%. Okay. Manulife is slightly lower. And their property are not in gateway city. So that's one thing for this REIT is they don't have their office building located in the gateway city. Okay, so different strategy. So depend on what they are looking at. So they don't locate in their gateway city. Also, they got in Washington DC. Okay, but they are not in the main city, like they in the suburban side. Okay, suburban Maryland. Okay, so but their property value drop. Their property value also drop. Okay, and these are occupancy. Let's look at our property value. They also value our property, and their property value dropped about 6.7%. Okay, compared to Manila is 10%. Of course, they got some of them is double-digit drop, but they don't have a 30% drop in property values for one property itself. Okay, but overall, it is still dropped. Okay, so from 1.65 billion dropped to 1.54 billion in property value. And what happened to their gearing? So their gearing also increased. Okay, into 43.7%. To me, this is not haven't triggered alarm yet, but to me, this is high gearing. Okay, I don't like REITs to have gearing more than 40%. Okay, in general, sometimes 41% is just temporary, it's still okay, but 43.7%. And if the property value will continue to drop, okay, then this gearing will have to go up. Okay, and the interest cover ratio, one thing good about interest is that the interest cover ratio is still very healthy at 3.8 times. Compared to Manulife, they dropped to 2.9. Okay, so this is some better point on that. And next is their debt profile. You can see that they don't really have 2023, they don't really have anything that need to refinance. But they got one big chunk here. Okay, which we need to think of. That's 2024. Okay, interest rate may not rise already. Okay, may not rise already, but interest rate will not just plunge overnight. Okay, will not plunge overnight. So this chunk will still have to be on a higher interest rate environment, but that will be next year, and hopefully everything will be better. But to me, it's still a big chunk. It's not nice. The profile don't look nice. Okay, the profile don't look nice, but there's nothing to be alarmed for this year. So there's something we need to look at next year on that. Okay, and their debt to hedge and fixed rate is around 80%. So you see that's most of the risks have been going on that direction. Okay, on the direction, sorry, going to that direction, but currently how much is it? But this to on that direction, which is good also, but ultimately the interest cover ratio were expected to continue to drop, because you can look at all the REITs, all their interest cover ratio keep on dropping when they report their earnings quarter to quarter. Okay, why? Because there is not 100% fixed. So there's a part that's floating, and this part will have incur higher interest. And if there is any debt that need to purchase, they need to refinance. And at this juncture, you see they will refinance at a higher interest rate. So most of the REITs, their interest cover ratio will keep on dropping. Okay, it's just that we need to monitor it don't drop below 3. To me, below 3 is something that I don't like. Okay, although MSA is 2.5, you don't wait until it drops to 2.5, then you press the panic button. Okay, so that is on this aspect. Okay, so let's look at this REIT. This REIT is KBS, is the sponsor. Okay, so you look at, it's a US REIT also, but look at the sponsor weightage. The sponsor is 18%. Manulife say they due to the tax structure, they cannot cross 10%. Okay, so maybe it's different tax structure. But okay, this REIT got 18% interest in this sponsor got 18% in the interest in it. Okay, quite good interest in that. You may see this Temasek holding, and some of you will see, how come Temasek got 12.66% in this REIT? Okay, Temasek doesn't directly invest in this REIT. Okay, Temasek is indirectly happen to be invested in this REIT. What do you mean indirectly? Capital Corp, 5.92%. So one thing very unique about this REIT is the REIT manager is a joint venture. You see, the sponsor will form the REIT company, the REIT company owned by the sponsor. But for this case, this is a sponsor. they joint venture one with Keppel Corp, okay, to manage the REITs. So Keppel Corp being the REITs manager also, they have a stake in the REITs management company. Okay, we call it capital investment. Keppel investment, not Keppel Corp directly. The capital. So which why Keppel Corp got 5% stake in that, in this aspect. And why Temasek got 12%? Keppel is belong to Temasek. Okay, and there's two company, Temasek Link company, have holding in that, and one is DBS Bank. Okay, another one is the sorry, I don't know how to pronounce it. Custom Pick, the one that the sponsor for SPA REITs. Okay, they also have a stake in this REITs. So all scale up become Temasek for 12.66, but Temasek don't have a direct interest in it. So the main part is still Keppel Group. They are the REITs manager for this REIT. Okay, so that is how this REIT is, and you can see this is the share price drop to 21 cents already. Okay, the NAV is 75 cents, so the price to NAV is less than 0.3. So the NAV have dropped. Okay, from compared to normal, if you price to book one, it is 80% discount. Okay, based on the NAV. It's trading at 80% discount, and the dividend is 31%. Please don't focus on the yield. Okay, please don't focus. Market cap is also become less than 300 million, so it's also ranked below in terms of market cap among all the REITs. Okay, and next, let's look at the third REIT. Okay, which is this Keppel. Okay, Keppel Pacific Oak. So a bit unique. Keppel Pacific Oak, the name tell you that this is Keppel, is the Singapore Keppel. So this Keppel is a sponsor for these REITs. Okay, that means they are also the REITs manager for this REIT, and yet they invest, yet the Keppel Group also a REITs manager for another competitor REITs. Okay, so that's something I find very interesting. Okay, on that is a business decision. Okay, so this REIT, the occupancy rate, you can see is 92%. The other two is less than 90. Okay, all are in the US market. Okay, and you got 13 properties. But this REIT have the smallest AUM, 1.42 billion. Okay, 1.42 billion. Okay, but one key thing about this REIT is this REIT, their properties is not located at any gateway city. It's located at growth city. Okay, on a growth city. You can see they are even located in the center part of US. Okay, center part of US in the growth city, and it's driven by tech and innovation. Okay, on that aspect, and this is why the occupancy rate is still better on that. And actually, and these are the city, you know, US citizens, they themselves also migrate internally due to tax reason or due to working reason. Okay, they leave the main city, go to this type of place to work, and I think the cost may be lower also. And so these Keppel REITs are in the city that have all these attraction, people coming in one. Okay, and what happened to the property valuations? I do not have the breakdown, but this is based on the FY 2022. You can see the property value never dropped. So Manulife have dropped 10%, 10+%. Premier Street, their property value have dropped 6+%. But this REITs, the property value never dropped. Although Q4, the property value dropped, but for the whole year, it didn't really drop. 0.2%, you can consider is flat. Okay, so this is what they are, and their gearing is less than 40%, 38.2. Okay, 38.2%. Okay, and their debt maturity profile is still 77.9% is on fixed rate. Okay, the interest cover ratio is still on a healthy side, 3.6 times. Okay, and this year, of course, don't have much to finance. Next year also not a lot. Okay, but 2025 will be a big chunk. Okay, 2025. You see, I don't like anything more than 20%, but that's 2 years later. We need to solve the immediate problem now first. Okay, so that is, but currently they don't have any issue on that. Okay, and let's look at their holding on that. Temasek 11%. Okay, do take note. Temasek, because other companies also. So actually, we need to really break it down. The main bulk is Keppel. Actually, they only about 7%. Okay, they are the sponsor, but it's a joint sponsor. And now is a Pacific Oak. It got 6%. So these two sponsors add together have about 13% stake on these REITs. Okay. So one sponsor get one part, one sponsor get one. So these two sponsors have this. And let's look at the data. This one I take extract from Poems because their stock website don't have all the information. So not like the other two REITs got all the info. You can see the market cap is 339. Okay, 339. So slightly better than the other two. The other two is already less than 300 million already. Okay. Their price to book is 0.4. Okay, also much better. The other two is already at 80%, more than 80% discount already. This one is still at 60% discount. Okay, because of that, that's why the dividend yield is lower, 18.08%. Okay, so this is on the three part. Okay, but let's look further. This is the dividend trend. This is the dividend trend. So first one is Manulife. So you can see that Manulife since the COVID-1920, you can see that their DPU have start to drop year on year. Okay, yeah, it start to climb up. Then COVID come, you can see that dividend have been dropping year and year, and there's a potential it will drop further. Okay, there's a potential it will drop further. Okay, if that's current situation that can't able to resolve. Prime US REIT actually also has start to, you can see that it's a slight decline in the DPU across the COVID period. Okay, Keppel Pacific Oak, they managed to maintain a dividend during the COVID period, but after that finally they drop. Okay, the DPU have dropped in that aspect. Okay, so actually all in a nutshell is the DPU trend most higher possibility, that's my view, of all three of them will continue to drop unless the US market can be better. Okay, this is a comparison chart of the three REITs. Okay, do think of this is my comparison chart. So they may have errors. Okay, so this is just for a reference only. Okay, and I based on last Friday price. So from here you can see 11 properties, 13 properties, 14 properties. Occupancy rate, Manulife have the worst, 86.1. Keppel Pacific have the best, 92.6. Okay, the market cap, all are low. It just happen to be this one is higher among the three. Okay, among the three. And this is a sponsor interest. Okay, I just extract from the annual report. Okay, but look at the dividend yield, all are, so you can just ignore this dividend yield. Okay, ignore dividend. What I want to point out, you look at the gearing ratio, this is 49.5, this is 43.7, 38.7. Okay, interest cover ratio, okay, 2.9, 3.6, 3.8. Okay, and valuation, this is 0.25, 0.4, 0.28. So is it a time for you to buy US REITs? Okay, there's one research report say that it's for the brave one. Okay, one of the analysts guys is for the brave to buy. Okay, so would the brave be rewarded? That will be another thing. Okay, but if really thinking of should you buy US office REIT, then there's three. Then you can decide which one to choose based on their financial strength, based on their sponsor interest, based on who is the sponsor. This is the data for your reference, but do think that this data is dynamic. Okay, you're subjected to change. Okay, so because I do this, I compare this about 2 months ago, then I redo again, I can see it get worse for all the three. Okay, so let's look at this is the 1 year return, recap again. So it's 73% drop. Okay, and you can see the Keppel Pacific drop lesser than the other two. Okay, but it is also not that good shape in the aspect. Okay, and I want to point to another. Is this only Singapore problem? Is it the three REITs that listed in Singapore? Are they the problem? Is it, or is it a global problem? What is my global? I want to look at US office REITs listed in US. Okay, US REITs market is so much bigger than Singapore. Okay, and they got 100 over REITs listed in US. And on the office REITs itself, they got about 19. Okay, at least 19, more than 19 office REITs listed in US. So I want to I take out 4 US office REITs just to take a look on that. 3 of them is the biggest in terms of biggest in the US side. Okay, one of the biggest for the office REIT, they are the biggest, the top 3. Okay, so first one, the smallest among the 3, this one is Leroy. Okay, so you look at how many property you have, 120. So the one listed in Singapore one, we only have what? 14, 13, and 11. And this one got 120. Okay, so you can see is so you can see it's a bit different compared to the Singapore one. But of course, they are the top 3 biggest one. Okay, so this is where their location is. But you see their office property is not purely fully office, but many is office, but they also got residential retail. But the office will be the main chart. They are in one part of US only. Okay, they are not the New York side, they don't have for these REITs. They are mainly on the this one is called the East Coast or West Coast. I also quite confused. This one should be the West Coast of US. Okay, and let's look at some financial data. So their market cap is 3.3 billion. So it's 10 times bigger than the Singapore 3 US office REIT. Okay, Singapore one is 300 million. Okay, average, right? Okay, dividend yield is not high. Okay, but look at the price book, also trading at a discount. Okay, 0.61. So about 40% discount. Okay, so this is on this one. Let's look at the other one. This is the biggest office REIT listed in US. Number 1, the biggest. So you got 192 properties. Okay, 192 properties. And let's look at the financial metrics. Market cap about 8.5 billion. Okay, 8.5 billion. Okay, and their dividend is only 7.93%. But if you look at their price to book, 1.28, they are still trading at a premium. They are still trading at 26% premium. Okay, so just now that one, the third one trading at a discount. This one, the biggest office REIT listed in US, is still trading at a premium, 28% at current market condition. But this is based on the latest price. Price to book is always based on the latest. Okay, and let's look at another one. Okay, Alexandra. Okay, this will be the second largest. This office REIT is a bit unique. Is they have pivot to life science. Also, they pivot themselves to life science real estate. So they also got life science properties. Okay, so this is a market cap, 20 billions. Okay, 20 billions. The dividend is very low and it's still trading at a premium. Okay, they trading. So these are the big one. So this is just some data, but I think the chart. Okay, I want to add one more. This one is really at Manhattan. Okay, this for those that don't know what is ESRP, it's called Empire State Realty Trust. You know, US got the Empire State Building. It's owned by districts. Okay, so district where the properties, gateway city, the key main gateway city, it is in Manhattan. So I purposely pick this street because it's at the property are mainly in Manhattan and New York, where work from home become more like a norm. People refuse to go back to work, and Manhattan become like a ghost town. Okay, so this is where this street will it be affected. Let's look at their data. So you can see the market cap is not very big, 923, but our 3 US streets add together still lose to him. Okay, still lose to him. Okay, you can see it's just trading on par. Price to book is on par. At current market juncture, Manhattan properties is still trading at price to book equal to 1. And okay, pause a bit. If you want me to take a look on the portfolio, you can just contact me on this. And for those that want to join our Jurong East team, okay, you can scan this QR code, okay, and open an account with us. And also for those that we know that we're migrated from Telegram to a WhatsApp community. For those that didn't get the link, you can just WhatsApp us directly. Okay, we'll send you a link. Okay, on that. Okay, now let's look at the chart. Okay, so this is the chart. From here, Where is the 3 US properties? Where is the 4? These 2. Compared to our 3 Singapore one, this is a 1, 2, 3 Singapore one, and these 2. So did they also drop? They also drop. Did they also drop quite badly? Actually, they also drop quite badly. Okay. You can see the biggest office REITs, the Boston, dropped 60%. Okay, 60%. Empire State in fact is Manhattan only dropped 37%, but all are equally bad. Okay, so Singapore office REIT drop, they also drop. Okay, they also drop quite a lot, fair bit. And let's look at the total return wise. So it's the same thing. The position don't change. It's just a percentage slightly better. Okay, but let's look at long term. The whole thing happened is because of COVID. Okay, the whole thing happened because of COVID. So let's look at from 31st of December 2019, before COVID. Then after COVID comes, there is a big plunge. There's a big plunge. So from the COVID to now, all are still losing money. Okay, the one that lose the least one is the Alexandra, because they got the life science property there. They only down 26, same as our REIT, similar to our REIT ETF. They down 20%. But the rest, the 3 US property, all down 60+%. Okay, just that Manulife and Prime lose even more than them. Okay, but they also down quite a fair bit. And if I have to plug in their dividends, okay, plug in dividend, you can see that the Alexandra one lost about 20%. Okay, not really much improvement because the dividend is quite low. Okay, but they are still losing that. So what does that mean? Means that at this juncture, US office REIT, Singapore office REIT, all suffer. Okay, all suffer. Okay, it's just a financial strength of that. But after dropping so much, you can see that the US office REITs, they are still can trade at a premium. At Boston, they still can trade at 28% premium. That means that if before the plunge, they are trading at high premiums. Okay, high premiums. Okay, so even Alexandra, all this at this current, and even the Empire State Building, okay, at the current market juncture, they only trading on par. But for the 3 Singapore US office REITs, if I'm not wrong, since day 1 until today, all the while trading at a discount. Okay, so that's a key difference. All the while they are trading at a discount, and now that discount is really too much already. Okay, can be 80% discount on that. So this is, so how to solve this is, will there be a turnaround? Then will depend on this thing called work from home and come back to office. The US side, people are going to come back from office. It's a bit different from Singapore. Singaporean, I think we are more obedient. When government say it's time for us to go back to office, then a lot of people will just, okay, let's go back to office. Government say, oh, we work hybrid 3-day office, 2-day at home, people just follow. Okay, on that. But for US, it's a bit different. I think US, even from Europe, people are going back to office also more. But for US, I think they are more liberal, more liberal in that aspect. So employee don't want to go back to office. So the employee got a hard time to asking them to come back to office. Yeah, but when I see that more and more people are asking employee to go back to office, like for example, Amazon, I ask people, their staff to come back 3 days a week, starting from May 1st. Is it May 1st? Yeah. So I don't know what is the outcome. But the hybrid model will be there to stay. Now the old time that people go back to office 5 days a week, I think they will not able to turn the clock to ask the US people to come back, work 5 days a week. And you see they choose to work Tuesday, Wednesday, Thursday. Monday, Friday, work from home. Okay. So they got a super long weekend. Okay. But because of that, the office space will definitely change. The office space will definitely change. Means that the company will downsize their office. Okay, and occupancy rate will remain low for US side. Okay, and this may cause downward pressure to the property value in US. So it is not over yet. Okay, but when it will be over, we don't know. Nobody knows. So if you really want to invest in the US office REITs, of the three of them that I show you, you must be prepared, okay? Be prepared for the long haul, okay? For the long haul. Any more further downside risk, especially when Manulife is going to come up with the proposal, okay, on selling off their risk management to another company. What will be the dilution impact to it? Nobody knows, okay? When they announce it, there may be a knee-jerk effect, okay? Hope most likely will be knee-jerk effect on the downside rather than on the upside, okay, unless the offer price is so attractive, okay? So because dilution, so if an knee-jerk effect on the negative side, the other two risks will be affected also, okay? Because all on the same ship, one down will pull down the other two, okay? But after that, the stronger one will survive, okay? The stronger one. So whether it's an opportunity or crisis, that depends on how we want to look at it. It can be a tactical allocation if you can stomach the type of risk, and you can stomach equity fundraising also, as the other two risks can, the two risks can also do equity fundraising anytime, okay? But I don't think they will want to do it at this juncture unless it's absolutely necessary, because it will cause, it will destroy the investor value on the risks, okay? So this is my view on the three US office REITs, okay? So do remember to do your own due diligence on that. So let me come back to this. So you want to know, just how I show you that the three comparison table, okay, is just part of the risk analysis course that I conduct, okay, where we will zoom in to analyze individual risks. Okay, just now that one is just a snapshot of one of the analysis table. Okay, of course, got more data inside, but the one I don't need to show everything because it will be too much. So this is the course I conduct, is to analyze the risks, okay, in more details. It will be conducted by me, and this 14-hour course is purely talking about risks, okay, everything about risk. And we also discuss about business trust, okay, because this one is create a lot of confusion. What is risk, what is business trust, okay? So we'll talk about the differences between risk and business trust, but ultimately the focus will be on analyzing and valuation of risk. So we'll try to cover almost all the 30+ risks, okay, listed in SGF in the course, okay, and based on the current data. So we'll talk about the metric, like what is dividend and how to look at sponsor, how to compare sponsor interest, and how to interpret their debt profile and their debt maturity, and also look at their debt, cost of debt, okay, from that. And then from there, we look at ratios. Okay, what are the good ratios? What is a good interest cover ratios? What is called adjusted interest cover ratios? And what is a good gearing on that? And also we look at their track record and how they raise money. Okay, how they raise money in the past, okay, will determine indirectly will determine the performance of the futures. Okay, and next, at risk manager paying money, we are paying them fees. How much fee are we paying? And are we paying them a good fees or lousy fees, or they charge too much? Okay, and this is where we look at the fees on that. And after that, we look at fair values. A lot of people say, and then what is the fair value of it? So we look at how to look at fair values. There's multiple ways to look at it. Okay, and by looking at all these numbers, the most important is when to buy and also when to sell. Okay, when to buy, when to sell. We will look at that based on the fundamental aspect. Then after, you use a technical chart to further assist us on a better entry price and a better exit price. Okay, and then of course we will definitely use those live example to show you what is a good price to buy, when is the time you should buy, when the time you should sell, and how you get this data on that. Okay, and after the cost, we also look at how to build a portfolio. Okay, we will talk about ETFs also, and also risk unit trust. From there, we will start to build a risk portfolio. That depends on the capital also. We'll talk about core risks and tactical risks. Okay, so there's core risk portfolio, there's tactical risk portfolio, and they will also look at how to build ETF to complement your risk portfolio. Some of you say, Darren, risk analysis too complex. Can I buy risk ETF? Okay, then we also dive into risk ETF expert. Okay, and of course we use a worksheet and checklist. I have done now actually a worksheet that have all the risk data there. Okay, so easy for you to have a one glance to see all the REITs on that. Okay, and also there's checklists on how to do peer-to-peer comparison on that. So it is not a theory class in a way. Okay, it is more of a practice class. Okay, where share with you how to find data, how to key in data. Okay, but do take note, some of them attend my lifetime income mastery will talk, well, then I need to submit analysis. No need to submit your analysis for this course. The only assessment for this course is multiple choice, 30 MCQ. Okay, you just need to finish 30 MCQ. The rest of the analysis you do on class is to help you to better appreciate how to analyze it. Okay, after the course finish already, because we are talking only about Singapore REITs, we have a special bonus. I'll conduct another special 2 hour of live webinar that I will only talk about Hong Kong and US REITs and also the US REITs ETF. As I mentioned, US got 100 plus over REITs. Okay, just I just sample out 4 of them to show you when compared to Singapore. Would you prefer to buy the Singapore office REITs or prefer to buy the US office REITs? Okay, so we'll talk about that on this and also talk about the REITs ETF listed in US. They got a lot of REITs ETF also. Okay, and this is an optional class. If you don't want to attend this US and Hong Kong REITs webinar, okay, you can no need to attend also. It's optional because that is not after IBF scheme. And I got this CQ station. There's a post-course support, okay, for people to join in after the course, and I can so-called provide lifetime support in that, provide them still around. Your question, you can post it there. Okay. And of course, I got this YouTube channel. You can subscribe to my YouTube channel where I'll try to constantly update on my view on the market on the individual counter, like listening. I just upload Capital Land Escort Trust. Of course, I got my Facebook page. You can subscribe and follow my other webinar. Okay. So this is the subsidies. If you are below 40 years old, our PR, 50% of the course fee is being funded by IBF. If you are Singaporean above 40 years old, 70% of the course fee are being funded by IBF. So the balance, 30 or 50%, you can use your SkillsFuture credit to offset some. Okay, if you still have SkillsFuture credit. And do think that you can see the subsidies have dropped over the years. And will one day the subsidy gone? I'm not sure. If we are going back to normal period, then maybe there's possibility will gone. But this is good for this year only, 2023. Okay, so this is the course date. You'll be on 2 weekday evening and 1 Saturday, all on the same week. Okay, so the cost fee is 1620. If you are Singaporean below 40 years old, LPR, this is $870 you need to pay. If you are Singaporean above 40 years old, this is the amount you need to pay, $570, and you can use your SkillsFuture credit to offset. Some will say that, then I want to learn about multi-asset. Then I got this lifetime income mastery course. It will happen only in end July and August. This will talk about multi-asset investment, building multi-asset income. So you are keen on that, you can also sign up on this. All this. Okay. For past lifetime income mastery graduate, okay, I think some of you are actually the graduate. You want to attend this reanalysis course, you'll be given $300 off. Okay, $300 off. But what you need to do is just register and then drop cybercall email. Then they'll advise you accordingly on how much you need to pay. Okay. If not, that's all about today's session. Okay, sorry, I can't talk too long today. Because I got a sore throat. Okay. Anyone got any other question? Can type on the chat here. Now I'll be able to answer it. Okay. If not, I thanks everyone for attending today's session. Good night, everybody.